Hello and welcome back to Simple Money, the show where we talk about personal finance issues that affect Canadians. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. So as you may know, I love tackling financial misconceptions and myths. And today, we're going to be doing exactly this. The misconception that we're going to be looking at today is about interest rates and what you actually receive. A lot of times we get quoted a rate, and that's the rate that we believe we receive. But in actuality, it's not that simple. The sticker price that you're quoted is not what you ultimately receive. Taxes, inflation, and compounding all affect your interest rate. Out of the three, taxes will typically impact you the most. Taxes on investments can be complicated to determine as there are essentially three different types of taxes charged. Those charged on interest and income, those charged on capital gains, and those charged on dividends. Of the three, taxes on interest and income are typically the highest. With investment income taxes, you will make your return, and then you will need to pay when you file your taxes, or when the CRA finally catches up to you. The whole process is not as transparent as it seems, because there's often a very large gap of time when you receive your return from your investments and then when you have to pay your taxes. To make things even murkier, often we just see the final tax bill and not how your investments contributed towards it. A quick way that you can determine your taxes is to simply multiply your quoted interest rate by your marginal tax rate. This is the amount of your interest rate that is paid to income taxes. This equation would apply for savings accounts, GICs, and any investment that provides income. Thankfully, there are a lot of legal ways where you can avoid paying income taxes. The best ways are typically through registered accounts like a tax-free savings account, RRSP, RDSP, and more. With some of these registered accounts, you actually don't have to pay income taxes on your investment returns at all, while others, you pay income taxes when you take the money out. That's why it's very important to understand the taxation of all your registered accounts. The next big impact on your investment return is inflation. In most general terms, this is the rate that the cost of living increases every year. Currently, inflation in Canada is sitting at 2.2%. This means that the average cost of living for a Canadian increased by 2.2%. An important note is that this is just a general average for all of Canada, and your personal interest rate will be much different than this. And this is a topic that we're going to explore in a future podcast episode. A general equation to determine your after inflation rate, also known as your real rate, is to simply subtract your estimated future inflation from your quoted investment rate. Of course, this is not exact, but it can give you a greater understanding of the impact of inflation. So for example, if you have a return of 0.9% on your savings account, if we expect inflation to sit at 2.2 for the next year, your return will actually be negative 1.3%. This means that your investment is actually losing value over time. The only way to really beat inflation is to have an investment return that is higher than expected inflation. The same principle of inflation actually affects your workplace earnings too. If your raise is less than expected inflation, then technically you just received a pay cut. Finally, compounding also affects your investment returns. Compounding is awesome. It can actually bump up the actual rate that you receive. Quoted rates are termed as simple rates, while rates adjusted for compounding are called effective rates. So for example, you still have that 0.9% interest rate savings account. However, it pays out at the end of every month and the interest compounds. This means that your effective rate is slightly higher at 0.904%. Hardly noticeable, but this can have a larger impact when you receive a higher interest rate. The math behind this is slightly complicated, but the idea is still there. So that's it for today, but you can see how the quoted interest rate that you receive is not actually what ends up in your pocket. Overall, taxes, inflation, and compounding will affect you. Thanks again for listening. I hope that you enjoyed the episode. If you have any questions or would like to be featured on a future episode, you can contact me at info@ffcoach.ca, or you can find me on Twitter at @F_F coach. Take care and see you in the digital world.